Okay guys, what we do now is we're just going to have a 20-25 minute panel session. It's quite straightforward. We've got Simon Deane-Johns joining the panel. Simon's a lawyer specialising in finance, and you're one of the original founders of Zopa.
Yes.
And the question I had for you was, how long did it take to set Zopa up?
Okay, so I joined the Zopa team. We were looking at trying to launch eBay for money. And I joined them, I think, at the end of July, sort of early August 2004. We finished the functional spec for what became Zopa the end of September. Got all our permissions through during December. We could have launched in January, and we did launch to lenders the end of January. And we primed the pump, and then took the decision to launch to borrowers in March, basically for commercial reasons. But we could have opened the door, but we just primed the pump a bit more than.
So what is that? 6 months? No.
Yeah, I suppose you would say, we did it in 4 or 5 months,
including the legals and regulation.
Oh yeah,
really?
I work fast.
There you go. Okay.
No, I suppose my background was in e-commerce from the mid-90s. And I did a startup in peer-to-peer payments called Earthport back in '99, and we raised a bunch of money just before the bubble burst. And so I had, I suppose, a lot of experience from that. And really, a peer-to-peer lending platform is just a peer-to-peer payments platform with an instrument of some description in the middle.
Right.
Not to belittle the whole thing, but so I was familiar with the model.
Okay. Okay, so do we have a question from the audience for the panel?
Good evening. I have a question regarding the crowd part of your crowdfunding proposition. If you have a crowd, you have retail. If you have retail, you have the regulator. How big of a barrier is this? How difficult is it to get approval and the right and the license to work with retail people? I think that one of you said that they were basically working as the agent or the satellite of someone else who has a license. I think it was Bryce Armory Capital or something like that. So basically, can you really tap into funds, or are you just an e-platform for a high net worth individual, which is basically a private bank?
So I'll go first. So if you look at the regulatory structure as it stands today, so the Financial Services Market Act, and Simon, correct me if I'm wrong, he knows more about this than I do, and within that there's financial promotions and regulated activities. So largely when you look at arranging investments, which is what crowdfunding is a portal for, if you're talking about equity here in this case, and very soon to be, there'll be debt in that space. You have certain obligations that the regulator ensures you do in terms of best practice, corporate governance, client money processes, to ensure that everything is proper and then nobody's going to run away with the money, and you do the checks. Now, you can either go through what's deemed as a direct authorization route, which there's a process, and you fill in the forms. You put the appropriate money and the roles and resources in place, and then in due course, if you're lucky, after some pain, you get regulated. And then there is a whole framework of what's known as the appointed representative, which is where the regulator allows principals, in this case the directly authorized firm, to use their judgment and the corporate governance and best practices to then sort of authorize somebody else. So the implication is, if something goes wrong, they go to jail, right? So effectively, the way to look at it is, for us, we had prepared parts of the direct authorization, but we felt it was a better method to hit the market purely because it's always arm's length, and it's an incentivization problem. So if we are directly authorized and we have to make money by pushing more deals through, then we could, in theory, cut corners to get more volume on, to get more deals funded, and we make more money. In this case, you have an arm's length compliance process, which we cannot circumvent because the two different incentivizations contradict each other. So there's a sort of air gap system to ensure that we're always doing things by the book. So we felt it was a better approach. That's not to say we're not going to change it in the future, but that's why we did it.
So just on that, I think it's important to draw the distinction between an equity crowdfunding platform and a lending platform, which is peer-to-peer lending, still sort of coming under the broad concept of being a crowdfunding platform, because the way the regulation is defined is trading a loan is not a regulated activity. So at the moment, if you're dealing in securities or you're trading securities or shares in a company, that is a regulated activity. Something like LendInvest, where we're essentially trading loans, that isn't. But that's where the FCA is in the process of putting together a regime where so it will become a regulated activity next year. But I think it may be wishful thinking, I guess, from our perspective, but it seems that from our discussions with the FCA, it seems that they are approaching it with a clean slate. So they're not trying to sort of force peer-to-peer lending platforms into the same regime as equity sort of trading security platforms in terms of the regulation there. So we don't know what that regulation will look like for loan trading platforms, but hopefully it's a sensible sort of regime.
Yeah, I mean, for a long time, I mean, when we launched Zopa, we tried to speak to the FSA in detail about the sorts of rules that we plan to put in place and offered to work with them to build some kind of rule book over time. They weren't really interested because it was such small beer. But over the past few years, we've worked with everyone from 10 Downing Street to the Cabinet Office to Treasury, BIS, you name it, to try and get some proportionate regulation in the sector, because these platforms shouldn't be hard to start. And we were seeing that the more, particularly people who are in the crowd investment space, who needed potentially to get authorization, were struggling big time to figure out, whether they were within the regulatory sphere or outside it. If they were in it, they were having a lot of trouble persuading the FCA or FSA then to exercise discretion in favour of getting authorised. Abundance generation, for example, took 2 years to convince the FSA to grant direct authorisation for arranging, which it should have taken a year max. So we've been asking for more proportionate regulation, and the authorities have realised that they need to come to the party and prepare the ground for these things to start quickly and efficiently, because there's the finances dried up.
Okay, can we take another question?
I've got a question for the gentleman from CrowdBnk. Who are your target issuers, or the people that would typically come to your platform?
So you mean raising funds?
Correct. Yep. And also, if you can just touch on it, for what sort of is the fee structure that you've got? How does that compare with who you might perceive as your competitors?
So I'll take the first one as with regards to who we can fund. So we are sector agnostic, and in terms of sort of funding size, we'll do anywhere between 10,000, what is meaningful equity raise, to up to 5 million euros. And the reason we sort of capped it is not because of regulatory reasons as such. It's because of the EU Prospectus Directive, Investor Prospectus Directive, which we can change our systems around, but we just haven't had enough demand. Of the 200 odd businesses I was talking about, what we looked at, currently we obviously triaged about, let me get this right, 54, which constitutes about 20 million pounds of demand, which is skewed in 3 or 4 taking up a large chunk of it, if you like, so the large sizes. So what we are seeing is more and more what I would call traditional viable businesses who are generating revenue and probably could get other forms of investment are starting to come to us for 2 reasons. One is they want to tap their existing customer base, and B, they feel that it's a more efficient way of raising the funds if you take everything into account. And what I mean by that is, now dovetailing into fees, is traditional for I'll take a retail bonds issue, for example. There's quite a lot of that going on in the marketplace, as Mr. and Mrs. Smith, the Naked Wines have just come out. To get a placement of a retail bond into their consumer base, you have to pay upfront corporate finance fees, which are not insignificant. And essentially, our platform does that and flips it such that you don't have to pay anything and you pay contingent on success. In terms of fees, Look, the traditional intermediary fees are anywhere between 5 and 10%. When we went and spoke to corporate finance boutiques who do kind of similar things to what we do, we've had quotes of anywhere between upfront 2,500 to 50,000, quite a wide variety, and anywhere between 4% and 10% of equity. Plus, they have financial director NED requirements that they impose on you, which results in a $6,000 a year perpetually until they manage your investments. So we think 5% success fee is well balanced in the value that we bring, and pretty much industry average is kind of there. If I may call out names, and if you compare, I think Cedars, I believe, charge 7.5% all in, but they have a carry sort of structure whereby they take 7.5% of the upside. We don't take any of the upside. It's a transactional model, whereas Crowdcube obviously charge 5% plus some legal fees. The additional operational cost that we pass on, we believe, is there to enable the retail piece that gentleman talked about, and the evidence is there to kickstart from Kickstarter. And when we ran IT systems in the past, if you take online payments off, the drop-off rates for the new age retail investor would drop off quite a lot. That's why those costs are there, and we're working with MasterCard and Visa card to drop it down, but until they're there, that we are at sort of 9% all in.
Thank you.
How do you handle investments that go bad? Like, say you give whatever, you have investors that give $2 million to a company, and something really bad happens, and they, in 3 years when they go to exit, it's worth 200,000.
I'll go first. So I think, look, crowdfunding or any new age finance platform inherently doesn't change the statistics of startups or businesses failing, right? Things happen, that's life. I think the key thing there is you've got to ensure that the appropriate governance and reporting is in place such that stakeholders in your business, in this case investors, are well appraised of your situation and scenarios and have some element of voice and understanding, so they don't suddenly put in 100 grand, 6 months later you go, I ran out of money, and game over. That's what we want to avoid. And I think what we can do is put in place appropriate reporting so that people are aware of how the business is progressing. Look, you cannot, well, you can. No offense, Simon. Lots of legal contracts are written for really, really hypothetical scenarios to protect potential investors, pref shares, this and that. And that's where the costs grow up. And most platforms, to keep the costs down, are templated, right? So there's only so much you can do to manage a business going bad. But the communication and the PR around it is where you can make actually a difference. And I think a typical example is Bubble and Balm was one of the first investments out of Crowdcube. Unfortunately, had to cease trading, and as long as the shareholders were kept abreast, I don't think it's a fact of life that businesses go bad. So
yeah, I guess. But thinking about it from your side, if it scales up and eventually investors to decide that you as the person preparing the prospectus or whatever, not the prospectus but the disclosure, didn't exercise due care, you kind of, because you're doing small businesses, you want to crank them out quickly and you go a bit sort of fast and loose. Do you think the legal structure isn't sort of very watertight, or is it something that when it gets tested, who knows?
Good question. Am I going to go to jail? Well, I think liability-wise, we've taken due care to make sure that the risks are appropriately displayed at all points in the investment process, and you're kept abreast of what the implications are of you getting your money back. But because we have retail permissions, we've had to put appropriate insurances in place such that people can complain to the Financial Ombudsman Service, and we have to comply and deal with it, and we have processes to deal with it. That doesn't take away from the fact that there is a PR nightmare you have to manage out, and at scale it may happen, and it basically your processes have to be robust. We did some exercises in in mock litigation code, but I'm not going to go into the details of it. But only certain cases, when they come to the front, will we know exactly how they're going to behave. But
the point to make too is that these are not collective investment schemes. This is not a case of sit back and, watch the money roll in. I think so long as the platform is clear about the level of due diligence that's being done in the first place, and as Ayan says, is transparent around the material risks. The whole point of crowdfunding or crowd investing is that it's down to the investor. And as Ayan says, you're not waving some magic wand. I suppose the hypothesis also might be that the fact that somebody's gone and raised money on such a transparent platform in such a transparent way may mean that they are going to be more open and transparent about the risks as they see them early on, and also be more open and transparent in their dealings with investors going forward. But again, I mean, if investors weren't getting enough information about the company, they're free to ask. It's the social media at the end of the day. So I mean, the risks of somebody going bust aren't magically waved away, but there's plenty of transparency on these platforms to at least I think improve on a lot of the mechanisms you're seeing in the angel world today or the seed world today in an offline scenario.
I'm just going to add to that. I think the more risk isn't of a company going bust, it's of a down round. So one of the things that we consistently see is we do our market research, and valuation is an interesting concept where because we are actually doing several hours, weeks of due diligence, there's a big part of it which is a valuation discussion, which is more a traditional corporate finance as opposed to crowdfunding. And I think my fear is other intermediaries not doing that would result in overinflated valuations when it comes to serious money, will take a down round. So that's when investors suddenly realize they're not sitting on a massively amazing portfolio, but it's been rounded down, and they may feel they're hard done by. But the reality is that the EBITDA multiples they went with in the first place were misplaced. And I think we take a lot of time and effort to ensure that the valuation is market tested before we bench it, even though we do not stand behind it from a underwriting or IPO issue sort of thing. But it's very clear that it needs to test well with our ultra high net worths before it touches retail. Because if you can't bench it, then we get lots of interesting valuations on a PowerPoint basis, and that's where the risk is, not businesses going bad.
Yeah, I guess so.
I'm assuming the question is only about equity-based models, because crowdfunding is also in large part about donation-based models and reward-based models, which don't really follow that pattern and therefore don't really go into the same risk-return perspective. Yeah.
Okay, we can take one more question.
Hi, I'm Dominique Miller. I've just got a question regarding the fundraising process. So whether that be a mortgage or a small business, how long is it taking to actually raise the money on these platforms compared to the traditional means? And also following from that, are you seeing any issues coming up during that period once you put the proposition on the website? I suppose maybe for LendInvest example, your traditional capital base is already there via the funds, but for CrowdBnk, I'm assuming you have to wait for the right amount of people to come together, and how long that takes.
Yeah, I mean, I guess that's right. From the LendInvest side of things, because we're trading secondary loans, as I said previously, sort of, if investor chooses a proposition that they want to invest in, from that moment they're earning the stated return. So that sort of is the answer to that. Just touching on the question before, I think the important thing with crowdfunding is trying to match the investor's expectations with the risk that they're assuming. So, investing in an equity or buying shares in a startup company is a different proposition to perhaps investing in a mortgage, but conversely, they should probably expect a lower return for that investment. So it's just a matter of, it comes back to the transparency point, but making sure that, investors' expectations are equally matched correctly. So someone that's buying shares that in a startup, it may not be the next Google. Statistically, that's not the case. But having said that, if it is the next Google, then the return potential is massive. But yeah, in terms of the investment proposition, they start earning a return straight away.
So I think it depends how you measure it, right? So I think there's a lot of talk around how fast, how quick, 22 hours, 15 minutes, and this and that. Our experience is what we used to call in the mobile world, from cocktail to cash. So which is first contact to actually having the money in the bank is anywhere between 3 to 6 months, depending on what you're doing. And now not all of that is done once you're there. A lot of the groundwork is done behind the scenes. It involves, depending on who you are, how big your consumer base is. So statistically, there's a big campaign element to crowdfunding, right? So one is building the investor story, and then second is having a campaign to reach out to your potential investors, why they would give you money. And it takes different times depending on who you're trying to get. So we say sometimes it's a crowd of VCs, sometimes it's a crowd of angels, sometimes it's a crowd of public, sometimes it's all three, and they all have different time zones. So the one of the big deals they're raising 1.5 million, right? So and there are 3 VCs involved, and they are not going to come on my terms or the crowd's terms, so they are kind of dominating. So it sort of varies, but roughly, if entrepreneurs are looking to raise cash, don't start raising cash 4 weeks before you run out of money. This is my advice. Normally, you're looking at a 3-month cycle, regardless of what you see out in the press.
That's actually a good point. If you look at statistics for crowdfunding platforms, they show how much cash is raised over how much time after they publish the proposal. What they tend to understate is the behind-the-scenes work that was just mentioned, i.e., the preparation work that goes into launching the platform, launching the campaign, launching the product itself, etc. So it may take 9 weeks to raise the amount of equity that they wanted or the amount of cash that they wanted. And again, it's different depending on whether it's donor-based or reward-based, equity-based, or peer-to-peer. But then again, I think none of them actually state their true amount of time invested. And again, it's all about cash flow management. So it's like traditional means of investment. If you're looking at startups in the entrepreneurial sector, you would also be looking at 3 to 6 months in terms of traditional funding. So crowdfunding does not change that. It just adds another source of investment to your portfolio. So if you were looking to raise cash, my advice would be try everything. Go to angel investors, go to VC funds, go to the level of fund that you're looking at in terms of how much you want to raise, and use crowdfunding as a complement or as an addition to that. Because it's going to create traction and do a lot of PR for you as well. It may not raise a lot of money, but it may get you a long way in terms of visibility, image, and the rest of it.
And I think this is where the Crowdfund Magic's PR package comes into play. So you can contact us and we can let you know about our PR and marketing package.
Okay, thank you guys. I'm going to wrap it up there. Thank you all very much.